This week, the dollar and treasury yields did something that should get your attention. Treasury yields went up and the dollar went down. Normally, higher treasury yields provide some sort of support for the dollar. When yields rise, the dollar rises with them because higher rates pull in capital from around the world. Instead, however, yields climbed and the dollar sank. On top of that, gold and Bitcoin just had their best weeks in months. That should have not happened. As rates rise, gold, Bitcoin, and all long duration assets should have instead gone down. And what makes things worse, all this happened as the US Treasury announced plans to double its bond buyback efforts in an explicit effort to help keep rates down. And yet, of course, rates went up. So when this pattern shows up, it's usually not about rates anymore. Instead, it's about confidence. Confidence in the currency, confidence in the government standing behind it. What does all this mean? Well, before we get into that, welcome back everyone to the Lunch Money Investing channel, where I break down market moving events to help you make better, more informed decisions for your portfolio and, of course, to protect that lunch money. If this type of content sounds interesting to you, please like and subscribe. It means the world. Anyways, back to the main story. So let's back things up a little bit. Why are yields rising in the first place? Why is all this happening? The simple answer is Treasury has to borrow an enormous amount of money every single month to pay its bills. It has to issue hundreds of billions of dollars of debt this quarter alone. And buyers are starting to demand more money to be compensated to hold that debt for the long term. Treasury knows this, and this week they tried to do something about it.
And we are going to make a market in these. We routinely do buybacks, and we're going to increase the size of the buyback. And Sarah, I would note that it could be more than the $4 billion per issue.
On August 19th, Treasury announced that it would double the size of its bond buyback program, literally buying back its own long-term US government debt in order to hold yields down. Yields, of course, immediately fell on this news. Investors, they loved it. And then the very next day, yields jumped right back up. That round trip is the tell. That's the story itself right there. When a fix works, the market stays convinced. But when a fix doesn't work, the market shrugs it off in less than a day. And that's exactly what we saw happen just this past week. So if you're an astute individual, you're probably asking yourself, how does a Treasury buyback actually work? How does it compare to when the Fed does it, or the Federal Reserve? And more importantly, where the heck does all this money actually come from? If they're buying back these bonds, that money has to come from somewhere, right? These details matter to you as an individual and of course as an investor. So when the Federal Reserve buys back bonds, quantitative easing, it can create new money out of air. It just prints the money, deposits it in the bank reserve, and boom, buys bonds. But that's not the case for the US Treasury. The US Treasury doesn't have a money printer, and neither do I. Every dollar it spends has to come from somewhere. And since we spend more than we make, that means Treasury had to borrow the funds to fund the very operation that's supposed to be calming down the market. It had to take on debt to pay down debt. That's never a good place to be. And because Treasury doesn't want to increase the long-term bond auctions, because that would simply add to the yield problem by adding more long-term bond supply, the money for these buybacks is coming instead from short-term borrowing, by issuing Treasury bills, which is debt that matures in 1 year or less. That's quite an important shift. Every time Treasury retires a long-term bond and replaces it instead with short-term funding bills, the overall debt amount stays the same. How much you owe doesn't change. It simply moves the due date closer in time, from 30 years to 12 months. And that's what I want you to remember for the rest of this video. Right now, roughly 20% of all US marketable debt is in short-term bills. The recommended healthy range is anywhere from 15 to 20% according to the Treasury's own advisory committee. And we're already past that 20%. And every buyback pushes us further out past the range. The Jenga tower is already unstable and we simply keep removing pieces. Why does this all matter? Because short-term debt has to be refinanced constantly. If you're the US government and a huge chunk of your debt comes due every few months instead of every few decades, you are far more exposed to whatever interest rates happen to be at the time you need to roll over your debt. Long-term debt, of course, locks in a rate for many, many years. Short-term debt makes you hostage to the market again and again and again. Every time it matures, you have to ask the bond market, how much do you need me to pay you? Imagine trading in your fixed 6.5% 30-year mortgage for 1-year mortgages at 5% that needs to be rolled over every 12 months. Sure, you save some money on interest rates today, but if rates rise when it's time to refinance, you've played yourself, you're cooked. So Treasury is effectively doing the same thing. They're solving a problem today by bringing down long-term yields right now by creating a problem for tomorrow, a debt load that's becoming increasingly vulnerable to interest rate spikes. This is the countdown clock on the whole story. Watch the bill share every quarter. The higher it climbs above 20%, the more exposed the US government becomes to all of this, and of course, us as taxpayers. And this isn't something happening in a vacuum. Total US debt just crossed $40 trillion for the first time and stands at 106% of GDP. Interest rate payments alone now eat up around 15% of the entire federal budget each year before a single dollar goes into defense, healthcare, or anything else. The deficit relative to the size of the US economy is now close to 6%, roughly triple the historical average the US ran for decades after World War II. And of course, inflation is still sitting above the Fed's target rate of 2%, not falling the way many policymakers and many of us would have liked. Put all of this together and you get the term economists have started using far more seriously: fiscal dominance. That's when the US government's need to keep borrowing cheaply starts to outweigh the central bank's actual job, which is, of course, is supposed to be controlling inflation. In a normal world, the Fed sets policy simply based on the economy and its expectations of that. In a fiscally dominant world, the Fed's hands gets tied by how much government debt needs to be taken out and the cost of all that debt. When Treasury is out there actively managing long-term yields, which it's doing right now, that's usually a job for the central bank. So you have to ask yourself, who is really steering monetary policy right now? Is it the Fed or is it the Treasury? Right? Two different players. And here's where things get more interesting, because this isn't just a US story anymore. Japan's central bank, the BOJ, is expected to raise interest rates later in September, and inflation there has come in hotter than expected for the last few months. For years, Japan has been one of the largest buyers of US government debt because US yields paid so much more than anything available at home. At Japan, the interest rates were near zero compared to 3.5% here in the US. But if the Bank of Japan keeps raising rates, that interest rate differential closes. Japanese investors get a reason to invest and keep their money at home instead of parking it into US Treasuries. And the timing could not be worse. This pullback would hit the hardest on the short end of the curve, exactly the part of the debt market that the US just made so much more important and more dependent on. So you've got the US leaning harder and harder on short-term borrowing at the very moment that its biggest buyer of short-term debt might be pulling back. That's not a coincidence working in America's favor. That's actually working completely against us. Now, to be fair, there is a real counter argument here, and it's worth taking seriously. A $4 billion buyback is genuinely tiny next to a $4 trillion debt pile. It's large, sure, but nothing compared to $40 trillion. Now compare that to the Fed's quantitative easing program, which ran into the trillions. Some analysts are pointing out that the market reaction this past week was nothing more but noise and some repositioning, and that any real structural shifts still hasn't really taken place. And of course, that Treasury still has plenty of tools left if things happen to get worse. And that's a fair counterpoint. The dollar amount really is small compared to the debt, but the size of that operation isn't really the story here. Instead, I think it's the pattern that the Treasury has started. Those buybacks started back in 2024 as a small technical liquidity tool. They then expanded them in 2025, and now within days of long-term yields hitting their highest level in 19 years, they've doubled them again. Each step looks small on its own, but strung together, that tells you Treasury's playbook, what it is today. Whenever yields get politically uncomfortable, they sell more short-term debt and buy back the long-term debt. That's the trend that matters, not necessarily the size of any single operation. At least that's how I view it. So here's what I'm tracking going forward for all of this. First, obviously, Treasury's next major announcement in November, when they'll reveal just how much bigger these buybacks are going to get. Second, we need to pay attention to what Fed Chairman Kevin Warsh says in his upcoming Jackson Hole meeting. Because if the Fed stays quiet while the Treasury manages the long term or the long end of the yield curve itself, that silence is basically an admission that fiscal policy is now driving monetary policy here in the United States. And third, of course, is the bill share number. That gets reported quarterly. If it keeps climbing past 20% and stays above that, it's confirmation that the US is increasingly financing itself with short-term debt in order to manage the long-term problem that it hasn't actually solved, the structural issue of overspending, right? None of this means, of course, that the sky is going to fall tomorrow and that the dollar is going to collapse. I think it's going to get weakened and there's a whole debasement trade going on, but that's different than actually collapsing. But like I said, this week gave us real signal. Yields jumped up, the dollar went down, gold and Bitcoin ripped higher. That combination is the market's way of saying it doesn't fully trust the fix that's happening. Whether this turns into a genuine crisis or fades into just simply another rough week depends on what happens over the next few months. But for the first time in a while, the bond market and the currency market are telling the same story. And that's usually the story worth paying attention to. Anyways, that's it for today's episode. If you found this interesting, please smash that like button and of course subscribe. Until next time, protect that lunch money.